So often some of the biggest tax bills come when we don't know what we're doing, when we're ignorant of the tax law. And an area I'm seeing more and more of, again, is the alternative minimum tax. A lot of people really don't think about the alternative minimum tax. They think, oh, that's a rich people thing, if they know about it at all. Uh, but I'm going to explain in this video what AMT is, how it's calculated, who it tends to hit the hardest, and how it can change things in a quite significant manner. In a quite significant manner. So AMT, the alternative minimum tax, is a completely parallel tax system that runs alongside the regular income tax. It was originally created to prevent high income people from using too many deductions. It removes some deductions and limits others, and it forces you to calculate your tax two ways, using the ordinary tax rules, but also using the AMT rules and then paying whichever is higher. Now, technically, everybody is required to calculate it both of these ways, but unless you have lots of deductions, the normal way will always be higher, so you don't have to worry about that. AMT has separate exemptions than the standard deductions. That exemption starts going away entirely at $500,000 of income for a single person, or about 1.1 million for a married filing jointly. And the tax rate is very flat. It's 26% on the first $220,000-ish, and then it's 28% on everything after that. Many deductions are disallowed or limited under AMT. You lose your state and local taxes. So this went back up to $40,000 this year under the One Big Beautiful Bill. Nope, that doesn't apply to your AMT tax. You lose almost all miscellaneous itemized deductions. You lose all depreciation adjustments. So, for example, from real estate, you lose tax-exempt interest on many bonds. And this is the big one for many people, it can affect your incentive stock options if you exercise them. So the result is you lose deductions you're counting on, and your effective rate may jump up at the same time. So let's look at some real-world examples. We take Lisa. Lisa has a pretty good job making $220,000 a year at a tech company, but she's also got a lot of stock options. She decides to exercise 10,000 of those stock options for $2 a piece when they're worth $22 a piece. Well, great. She's making $200,000 overnight, and under ordinary income tax, that's not a taxable event. The exercising of the stock options is not taxable. And eventually, she'll hold it, she'll sell it, and she'll only pay probably 20% or 15% for the long-term capital gains. Unfortunately, with AMT, you take that $200,000 in gain and you add that into her income to calculate the AMT. So suddenly her AMT income is $420,000, and now she's paying 28% on most of that. In this particular instance, her taxes were $40,000 higher this year because of the exercise of that option. So this is a case where maybe doing a smaller amount, spreading it out, would have saved her a lot of money, but she didn't know. This is the most common case I see people really get hit by the AMT hard, is this phantom income from a stock option. But another case, James has a great job. He makes $400,000 a year. His wife is a real estate professional. So they buy a property and they do a cost segregation study. And they're going to get $80,000 in bonus depreciation. Well, with the income tax, that reduces his income by $80,000. He's going to save $28,000 or more in income taxes. But under AMT, you don't get that depreciation. Now, you do get some of that deduction, but not all of it. So you lose that $50,000, about $50,000 added back to AMT income, but now also that you're AMT land, you're losing your state tax deductions, which in this case was about $30,000. So suddenly, if you calculate this out, his regular tax liability after the bonus depreciation is $100,000, and his AMT liability is $120,000. So he owes $120,000. Now, he still came out a little bit ahead by doing this, but it was only about $8,000 better that he saved by going through all this and doing the bonus depreciation. That's a lot of work for $8,000 in tax savings. He just didn't know about AMT, and so he didn't make sure he planned around it. So if you're combining real estate with a high net income, and especially if you have high property taxes in your state, AMT can really, really come out of nowhere and cost you tens of thousands of dollars. So the people who need to watch out for AMT the most are people with incentive stock options. That's the number one case. Number two, high income earners in high tax states. This can include California, New York, New Jersey, but also Texas has very high property taxes. And so it can come up here. If you have especially large depreciation deductions, it's something to watch out for. If you're doing anything with installment sales, you need to watch out for this because AMT can come out and bite you in the butt if you do an installment sale. And realistically, anybody making over $500,000 in adjusted gross income in a year, you need to be watching out for AMT because it doesn't take much for it to step in and again kick you in the butt. Now, if you're making a strong income and exercising options or investing in real estate, you need to have AMT be a part of your tax strategy to make sure you're getting the tax savings you think you're getting. It is something you must plan for in advance. By the time you're doing your taxes in March or April or June or July, it is way too late to do anything about this.